Howdy, Jacob here. Today we're looking at Brightsphere Investment Group in the capital markets industry. 828 million market cap, just under a billion enterprise value. They publicly owned asset management holding company formed in 1980. Revenue is way down, actually less than half what it was 10 years ago. We're going to have to look at the cash flow statement to see if there were any sell-offs, but we are seeing way higher margins on both the gross and operating side. Dividend, they still pay a dividend. It's just 0.18% yield, and it's nothing in comparison to their earnings per share. Return on invested capital, positive. Return on equity, very high, but almost was negative last year, so likely liabilities were greater than assets, which you see right here. And it's greater now. So we have 147 million cash on hand with 274 million long-term debt, no short-term debt. That's about 100 million net debt. And yeah, I mean, we're likely not concerned with the debt, but there was some big sell-off here. Hurts their business in 2021. Let's see. So other current assets, 443 million was sold off. Okay. So big sell-off of assets there, and there looks like there was just other current liabilities that are just not there anymore. So debt is manageable. We're definitely not concerned with that. Free cash flow, we just don't have a lot history of where the company's at now with the big change that occurred in this 2021 period to where they've been buying back a lot of shares, but and they've been paying down a lot of debt, but they're down to not a whole lot of debt with a good amount of cash on hand. So we're going to see if the company reinvests, make acquisitions, or just buys back shares and pays this very small, maybe 5%, sub 5% sub 5% of their free cash flow to pay towards dividend as a payout ratio. So let's start making some assumptions. I mean, I don't really know what to do with all of this. I guess maybe just 2 and 12. So 2% revenue growth a year over the next 7 years, 12 on the P price to free cash flow, because at the end of 7 years, just not fantastic. Margins, free cash flow is lower. I don't necessarily like that. So maybe it's kind of all over the place too. Let's do 15, 12 with share repurchases of 1% would be about 8 million. And they can afford way more than that. So 5% would be about 40 million. That seems pretty reasonable. Let's do minus 4%. That'll be about 32 million of their free cash flow going towards share repurchases. I mean, they've been all over the place, but that should be about 50% of their free cash flow there. 5% on dividends, the rest going towards debt reduction if they want to, or more advantageous things like acquisitions and reinvestments to get these types of returns on revenue and margins. So, I mean, I don't know. I'm pretty skeptical about it because the results of their margins and everything and revenue is just all over the place. But it's just another reason to be more conservative here. And still, we're saying it needs to fall in half to get the return we're looking for. So, interesting company. Not as interesting in an interesting way. I'm not saying good or bad, but just one that, it doesn't look obviously cheap to me. So thank you and have a great rest of your day.